Today we're going to be talking about gold ZILLA. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. We're going to talk about gold today. We're going to review yesterday's gold and British pound trades. A couple of questions regarding the British pound. We're going to review a couple of simple things and understanding that before each session it's important to identify where the high and the low are for that session, where the profitable stops are, and then waiting or watching for the stop hunt unless it's already occurred, and then positioning yourself in the direction of that peak formation. The most important thing to grasp and understand is that at the highs and at the lows we have money, and inside there somewhere as well we have money, meaning we have a profitable trade that's happened either in the most recent session or at the beginning of the day or at the beginning of the previous day. It might be the low of yesterday. They might have worked it up and put a peak formation in, as we saw in gold, and rolled it over, not only for a measured move but an explosion of over 200 pips, and again in the direction of the trend. So sometimes it's deceiving. We get caught chasing the trend only to get caught in the right direction, but then they put 25, 50, maybe 75 or 100 pips in the case of gold against the trend before they roll it over. And again, we talk about the importance of timings, but the importance of understanding that they're going to hit the stops. Even on a breakout trade like the British pound, we saw a classic example yesterday. The market went up 25 and eventually 50 pips, put a peak formation in. We had traders, we're going to review this on the chart, came up a second time with a lower high and gave an engulfment after a narrow range combination from the previous day as well as yesterday's session for a breakout trade. Now it's important to understand that if you are shorting something like this, even though it's an engulfment, you are counter trending an explosive move. Now we had a middle structure, okay, we have RM, we have an engulfment, but this market came down in 3 bars and still didn't break the middle structure. The next bar was a bull pin in reversing the trade. When these trades are set up to go, they break the middle structure because now we have geometry for a measured move. This market did not break a middle structure, but also it was a very strong explosive trend trade day after a narrow range breakout. Now the market proceeded up another 25 pips before it gave us our M structure in the US equity session, at which point it made a similar setup, but it also engulfed and broke through the middle structure in the last candle of the equities hour. So again, that first couple of candles in that middle hour after the stock exchanges is open took traders one more time up into the peak formation before engulfing it and then breaking back down and moving 50, 75 back down to where that move originated. Now gold is, a lot of traders have asked me, how do you trade that? How do you trade that? I trade it the exact same way. Some days, today we've had a peak formation put in place. They moved it down 100 pips in the Asian session. That market will give you 50 pips, but it's important to understand that before each session starts, we want to see them either continue and move and stop out traders from the short this morning in Asia, or we want to see them go back down to the low. We want to see them either put a pin up top or put a pin down below for confirmation that they've done their work. And even if it's only a 25 or a 50 pip move, even when you've been in the market, if you've shorted this, and this I've talked about, if a market spends more than 30 minutes at one level without continuing through 2 bars on any time frame at that level without continuing through, I close that position out, because in a lot of cases that's a 1, 2, 3 into the low or the high of that structure for a reversal back towards the other side. So 30 minutes on the 15-minute charts. If it's at that level and it hasn't broken through or hit my target, or if it's at the low or the high or round numbers, whatever that may be, I'm out of that market. So gold, though, on the other hand, you might get a engulfment. We might get a stop hunt to the high and then a stop hunt to the low, setting up a lower structure. So it maybe stop hunts into an existing long trade off the low, as we saw today, before it pulls back inside and it traps traders in both directions and they're not sure which way it's going to go before it resumes the trade. Yesterday we saw an example of a market that put a peak formation high in, 3 pushes before rolling over, and then breaking through, pulling back in the US session, working the high again in 3 pushes, rolling over, and exploding down for over 200 pips. So we talked about anchor points, but the importance of this 3-hour window. That first hour, we should often see a stop hunt to a high or to a low or into a previously existing profitable trade. And that stop hunt to the high or to the low may be the stop hunt into an existing trade in the opposite direction from the previous session. But if we're getting in before they've done the stop hunt, you want to make sure that you're trading in the direction of where they're going to take out that extreme or stop hunt into that extreme. Now, if they stop hunt into a level without taking out the high or the low, so we've talked about hitting trades for break even, they may not go to the high, because if they go all the way up there, they allow traders to get out with profits. They might come right up here and then reverse it on the next candle, pull it back one more time, and then aggressively go right back down. You might have been up 25, maybe more, maybe 50 pips. So sometimes that stop hunt at the beginning of the session is only to get traders chasing the move up high, but also to not allow traders to get out with any profit. We're going to look at the charts again, but I want to see a stop hunt. Once they've done the stop hunt, that's when I know I can position myself into the market. Now, on the pound, for example, when a market explodes out, if you're not already in that trend trade, what I don't want to do is counter trend a strong trending market. We've talked about narrow range days. We had a narrow range day on Friday. We had a narrow range Asian session. They moved it up, I think, just over 25 pips. They came sideways, they came down, and then they went back up, put a high in place, and broke out for the trend trade right at the beginning of the session into London. When you get a breakout trade and it's a strong day like that, okay, golden rule, DNC, do not counter trend. Now, that's different than a peak formation at the high of the day, where we've had a high, they've come back, and they've given you a trade. Now, when a market breaks out and goes vertical after a narrow range squeeze, you do not want to counter trend that market. Those peak formations are designed to trap traders, and then they move it up another 25 pips. If you get into that trade and you get stopped out, keep your stop at the 1-bar stop, and you get in on the next trade. Even if you took a 20 pip stop loss, that next trade gave 75 pips. So just remember, even if you get in, you get caught in the wrong direction, that 1-bar stop is what's going to protect you in the next trade. That's what's going to allow you to be profitable and consistent if you're taking 50 pips off and sticking to that trading plan. But remember, 25 to 50 pips outside of that Asian range. But yesterday's an example of a squeeze, a narrow range explosion day. You do not want to counter trend until that trend has exhausted itself. And again, peak formation, New York session, but that market gave you 45 minutes to get out before it hit your stops. So just something to consider. 30 minutes before it gave the bull pin bar, it might have even been an hour. So there was plenty of time. You're in that trade. That next bar after you're in should break the middle structure and be moving fast, as we saw in the New York session. So engulfments, pin hammers, a 1-bar stop, 25, 50, and 75 pips. And in the case of gold, if you're in that big move, as some traders were, they caught over 200 pips. There's your week, maybe your month if you're in there with size. But those trade setups show up all the time. and again we'll review this. You get a bullpen and we get structure setting up. You should be looking for those trades that give not only 50, 100 pips back, but even maybe a measured move more for, as we saw in gold, 200 pips, hence the term Goldzilla. So let's take a look at yesterday's charts. Keep it simple, traders. Stop hunt, trap, trade. If the market hits the high or hits the low, pulls back and rams to the other side and you feel like you're chasing the trade, remember what we spoke about. If you miss the low, look for the high. If you miss the high of the day, look for the low of the day. It may be in the next session. You know, the pound runs away, you're not sure, keep thinking, next session. At some point there's going to be a stop hunt back in the other direction, as we saw on the pound. Traders who were up from the start of that session at the beginning of Europe and London, if they did not take any profits, would be kicking themselves because they had the popcorn trade. Straight up, straight down, wake up later or at the end of the session with no profits and maybe even a loss when they were up 50 or more pips in that session. Take profits, keep your stops tight, keep it simple, wait for the stops to get hit. Don't chase the trap, and then enter the trade, engulfments and pin hammers. Place your 1 bar stop in there and your profit target. If it moves through a middle structure or through a level, be prepared to move your stop to break even or a quarter level, because if this market's moving quickly, it's a stop hunt. In 4 or 5 bars, you should have your 50 pips or maybe more. So hopefully you got some value from today's video. Keep it simple, traders. Again, thank you for a ton of great feedback. Again, just trying to work through questions. High and low of the day at the timings. Very specific, very simple, very straightforward. Stop hunt, trap, trade, engulfments, pin hammers. 30 minutes at one level with no change in your price action. After it's moved, if you're at a low or a high, or round numbers, high or low of the day, I'm at break even at a minimum if I'm not closing out that trade and taking off what the market has allowed me to have on that. If it's moving fast and quickly and I think I'm in a bigger trade, I still will a lot of times lock that in and call it a day. So stay disciplined, traders, stay focused, keep it simple, have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. We're reviewing the gold trade from yesterday as well as the pound. So gold in Asia, we came down from the U.S. session, last swing high. Traders shorted the gold going into the close of the market. We had 1 push, 2 pushes, middle structure on the rollover, and then a 3rd bear push before we had an engulfment. So again, 3 pushes, working the low, and then an engulfment, putting a low of the day at that particular time in place. When we went back up, they hit stops on traders that were short from that U.S. session. And again, dropping down in Asia and putting a peak formation in place before coming down and putting a new low of the day in place. The market engulfed in that middle session of the Asian 12 candle window before working sideways in 3 pushes, and then heading back up again towards the high of the day. Traders are short up top. The market works its way back up just prior to the 12 candle window to hit stops, hitting up near or at the high. Again, traders may have been at break even. They may have just gone far enough to do whatever work they needed to do. We had an M structure from Friday up top. So again, that middle structure, if we drew our line across, the market was working back up into that middle structure, hitting stops, 3 pushes. So we had the low of the day in place, and then we had 1 push up, 2 pushes up, and then a 1, 2, 3 down, and a 1, 2, 3 up. An engulfment. This is after we've been to the high, so we have an engulfment after a 1, 2, 3 back up to the high of the day inside of that peak formation. An engulfment, and then a bear pin doji beside that engulfment, which also engulfs the second bull candle in the second candle of the equities hour. So again, the importance of timing and the importance of understanding the 3 pushes and also the 1, 2, 3 They'd already locked in the high of the day. They put a peak formation in, that 1, 2, 3, and engulfment confirms that. Drop down sideways, a second engulfment of the second candle. Any area in here, whether it's the engulfment, fighting for a better price at round numbers at 50, or trading the break of this candle, understanding that once they break the low of the Asian session, we need to be going to break even. This is a trade that I did take. I did enter into this trade on multiple areas, but again, when it breaks through a structure, going to break even, taking profits, whatever your goal is on this particular setup, then the market, if it does come back very aggressively, you've either taken profits, you're at break even, you're protecting your risk, whatever that may be. But now we're in a market that we're up high for the week. Okay, so we've gone into the peak formation. We can possibly extrapolate a measured move of at least one full expansion of that range, which the market did continue to work its way down to. So this market offered a fantastic opportunity for some asymmetrical risk reward. But again, just understanding peak formation, this market went vertical on Friday, gave us our double top formation, and stayed sideways in a 50 pip box. Underneath of that peak formation, they worked back up into the high in 3 pushes. They went 1, 2, 3. They had an engulfment at the open of the equities hour, then a second engulfment, and then the runaway. Now, as we headed into the U.S. session, we spoke about this yesterday, having a trading plan heading into each session. We mark off our highs and lows. This was just a great example of the market came up and gave us an M structure with a engulfment. Now, some traders shorted this market for 25 pip move or to the low of the day, understanding that they knew that this could fail as we headed into the beginning of this 12 candle window. So they've traded the market down to the low. Some have taken money off, some have just gone to break even, but with the understanding that this possibly was a peak formation. Then the market came back with a 1, 2, 3 sideways, inside, almost inside bar, doji pin hammer in the middle candle, the third candle of the equities hour. So again, rolling over. We talked about this anchor point low. So we have our anchor point. They've come down and give us an anchor point, and then they've come up in 3 pushes. There's our little house structure before rolling over. So anything that violates that third candle, once that third candle's printed, because again, this is now a bear pin hammer on an hourly chart. It breaks that low, there's your 1 bar stop, and that market exploded for over 200 pips straight down. So again, the market went sideways underneath the peak formation. 3 pushes into the peak. It's broken down. We have a breakout, pullback, hits the low, pulls back in 1, 2, 3, sideways engulfment for an explosive breakout through the previous day's low, but also through the low of the day for not only a measured move, but a huge move in general. Goldzilla. So we had a day 0 on Thursday. Market put in peak formations on both sides and effectively just stayed in a trading range back and forth. This is sort of the textbook sign for a potentially big move building. They came sideways on Friday and did a very similar type of day. Even though they had moved higher, they traded sideways in a very, very tight range. So again, if I put my measuring tool on that day 0, the market did not break out on Friday, but we saw that early breakout yesterday, which again, my focus has been mainly on gold. It moved up higher in that 25 pip box. We saw this early on that the market had dropped down and saw that it potentially may be working the high. Well, it certainly worked the high. We had a breakout pullback situation for an explosive move. So again, an example of hitting the stops, and then trending. But when we see a market explode like this, this is a breakout. This is not a stop hunt. When a market breaks out like this, my golden rule is DNC, do not counter trend. So I'm expecting this market to have a bit more juice before it finally fails, unless it just goes vertical for another 25 and then ends on a 2-bar peak formation. The market came back in a 1, 2, 3, came up a second time where traders shorted this, what perceived to be an engulfment. And again, an example of where if you were in this trade, so you've shorted this market and then you've got 1, 2, 3, 4 bars, 1 hour, and the market has still not taken out this middle structure. That is a very red signal, a warning signal to be either at break even cutting this trade or getting out of the market, doing whatever. But this market, when it's, as we see in the US session, when these trades roll over, they break out right away through the middle structure. So again, you're counter trending an explosive breakout trade. This is not a 50 pip stop hunt. This is a vertical breakout trade after a narrow range squeeze. Very important to understand. Hit the stops, hit the stops. They've broken out. They broke out early in Asia. We were already in breakout mode. Very important to understand that. We get 1 push up, 2 pushes up, and then of course the next 25 pip extension is the 1, 2, 3 to the high in the beginning of the US session. They pull it down. They give us a middle structure. They go up at the beginning of the equities hour for, again, getting traders chasing that, what they perceive to be the follow through. We get almost a full engulfment, a second candle of the equities hour. So again, perceiving time and understanding the candles in this, as each candle prints in each hour structure, how that's presenting. This second hour is our equities hour. We're up high. That next candle that breaks the low of that second candle, which engulfs our right shoulder, immediately breaks through. This market should not come back. You should be at break even at this stage or pretty close, as opposed to being in a trade 1 hour and that middle structure hasn't been broken. Cut that trade, take the small loss, get out, whatever you need to do, be at break even. But that market should behave like this. When it's ready to go and it's a reversal and they've got traders caught, it will move quickly. And the reason it moves quickly, again, the close of this candle, as you'll notice, is completely underneath of all these bull candles. That means that all this bull volume, everything that's bullish above this level, is now caught in one candle. And the reason why they do that is because they have all this money trapped now, and they're going to move quickly to not only hit stops, but possibly blow out traders' accounts if they're over leveraged, over margined, whatever that may be. And again, it goes right back through to the low of the day. 2 candles hit the low of the day without breaking through, out of the trade if you're not haven't already taken money off the table. But very important to understand, when these are going to move, that middle structure should be broken right away. There should be a fast move in the opposite direction. Again, this market was a breakout trend trade. 1 push, 2 pushes, and then a third push that culminated on a 1, 2, 3 as we entered into the 12 candle window. Asia put the low in at the time. London continued that range extension. The US put the high of the day in place before hitting the low of the day and hitting stops. So hopefully you got value from today's video, traders. Peak formations, stop hunts, 1-bar stops, engulfments, pin hammers, and again understanding the difference between a breakout trend trade versus a stop hunt hitting the highs as we see up top. This right shoulder hits the inside peak formation. Traders are already short, doesn't have to go all the way through. That allows traders, if they're chasing this move on the follow through, to go to break even or to take profits or to scalp, whatever that may be. They're caught right away in one candle before that market drops through the middle structure, and then boom, one candle explodes through that whole range. And that's what you want to see. Fast move, because that's what a stop hunt is. They're going to trap traders, they're going to hit their stops, and they're going to catch them before they have any chance to either get out or make changes to their positions, whatever that may be. Have a great trading session. Stay disciplined, stay focused, keep it simple, work from the high and the low at the timings, and may the markets go.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.